But I don't know, I've never had an
Alright, let's
experience
see.
where I was like totally confused. Oh, only one time.
Okay, welcome back, guys. Welcome back to Intelligence Maxing Day 30. So, I'm at the computer science building right now, and I'm going to try to finish the thing I was working on earlier. I got confused on how we can calculate the buying and selling of. I'll show you guys what I mean. All right, so let me try to fix my display first. I have to rearrange this to make sure that I can kind of just scroll seamlessly. Okay. Okay. So this question, we're trying to find. Oh, Allison, what's good? Allie. I have one person watching. Okay, that's beautiful. All right, so let's see here.
Yeah, the one that girl.
All right. So I know that if you have a positive exposure more than 100%, and also if you have a negative exposure, then you're gonna have a destabilizing trading structure. So, man, okay. So I think.
Have you seen it?
I actually really liked it.
You liked it, okay.
But like,
In the table that Pete gave us, we have a. If there's a negative 2% return,
I like it because I like it.
if you have 200% exposure, that means you have a negative 2% return. And why would you have to sell 2% of the existing exposure? I feel like that's something that I'm not really understanding the underlying intuition. Let me try to think about it. So you have 200%, so that's 2
Well, if you're going to masters and like not
times, so you have 2% decline. All right,
Masters is like way easier.
it'll be
Undergrad's way easier.
How was your
negative 0.2.
Oh my god, my undergrad is way easier than my high school. My experience? Oh.
Okay, so 1 minus 0.202. Then you also add negative 0.02.
Yeah.
So this is a 100% exposure.
And also the APs. And went to a school where like there wasn't that much of like a help. Like if you went to Blair, like people like know how to like do
0.3 minus.
Yeah.
So it'll be
The only thing
2.
about college for me that was like easier than high school was just that like I wasn't commuting so much to
Oh my
school
God,
and
you-
like soccer practice.
Wait,
and shit.
times
Like, when I had to go to
0.003.
class, I just like walked to class. I didn't have to drive. So
Exactly.
that was the only thing. That was
So
like,
this is the exposure. We have 2, and then we add. Let's see. So exposure is equal to 2, and then we also have our return is equal to
But then every day.
yeah, that's annoying.
it'll be 2 times. We have a negative 1% decline, so that'll be a negative 2% decline, right? And then we have the total, I guess, exposure after returns. Exposure after returns is equal to exposure times returns,
Like if I
right? And then now let's print out this exposure times after returns.
last semester,
Okay,
I don't know.
let's see what this gives us.
I maybe have like one class that has an exam. And then I just do like research.
that's true.
Which is like the thing I'm good at. You know? Like undergrad.
Oh, I think maybe 1 plus returns.
But I only do that for you.
Exposure times.
He stresses me out
You stresses me out too. I'm scared of that.
because like
So exposure times 1 plus returns. Okay.
Is he paying in high school?
No, he's actually not, but he like doesn't really have a plan otherwise. I think.
Okay, wait. I get this
People just, like,
2 point.
He doesn't wanna go back though.
This is okay. This is yeah. I know he doesn't
He
want
hates
to.
it there.
He doesn't. Well, he said he didn't hate it. He really liked the company, but he doesn't want to live in Wisconsin.
No, yeah, that's what he said, he hated it there.
Okay,
So-
this is confusing me because I'm getting 3.96. What the fuck does 3.96 mean?
I know.
Alright.
Is he blind?
No, okay, yeah. So this is what
You might just have to take his semester off.
because I was like, what happens if the guy
Allison, help me.
He was like, I don't know, like a month. Or something.
Bye, Allison. Thanks for watching. Thanks for watching.
I know.
Thank you.
Oh.
Okay, so how much should the fund
This is a, well, I don't know.
buy or sell to rebalance the fund's exposure?
And then you get the rejection.
No,
You
no,
would be
he's-
fucked for that.
No, this is like, he's been doing this.
Yeah, you were always gonna get it. I don't know why you're acting like you were never gonna get it.
Girl, I don't.
You were always gonna get it.
I clown myself. Anyways, what were you saying?
Okay.
She says in like a month, then what?
Yeah, if he doesn't get in, I was like, so what are you gonna do?
Right.
Because then you'll be like graduating college. And I was like, you're not gonna, because right now his plan is like to just go work at Epic for an internship again. Because they gave him like the return or whatever.
Okay, so we have the exposure of 2,
No, I
and then
know,
we
but
have
that's because
negative
that's-
2%.
And then I was like,
So this is
so
negative
what happens if-
2%.
Oh.
Exposure after returns.
No, he literally can't move to Wisconsin because he said he signed the lease for his place for next year already.
Plus 1.
No, that's what he said. He said if I don't get in, I will apply to jobs here. But then I was
You
like,
should
you can't
still
apply
apply.
now. Or I was like, you can't start applying in a month and expect to just like people to hire you.
Maybe.
Like he could.
Does he wanna work with Mirror?
Right.
He low-key said a job in DC doing security.
Doing security?
That's what he said.
Does he know anything about security?
I think he likes the network stuff.
Oh, he's so lucky. He's good at network.
Yeah, he is. But I don't know. I was just like, oh.
2.98.
I mean,
Wait,
first of all,
plus
he'll be fine.
returns.
He'll be okay.
Yeah, no.
I think most likely he takes a semester off. Considering like what is going on. If he doesn't get into grad school, he's taking a semester off.
Okay, I feel like this makes
Gets
more
in,
sense, right? We
Either
then.
way, you should still apply for intern.
So then his exposure is at 1.98. And in order to get that 200% exposure,
You might go-
would he have
If
to
he-
sell?
I think if he's doing an internship, he wants to do it. But he doesn't want to.
So he would have to sell?
He's
Or
trying
no?
to get a security job.
Because he hasn't been looking at other internships.
I get the conference.
Yeah, no.
And I'm like overqualified. That's not a joke.
Or do you have to subtract a return?
Yeah. Well, also granted, I'm applying to jobs that are like crazy, but yeah.
Okay, this is, man, this is so confusing because how am I getting a less exposure? It would have to be higher, right? So if he's having a negative return, I would have to have a higher exposure, like 200 or 2%.
Did not know this.
Oh, yeah, he has, his grandma has a apartment like in the woods. It's like right on the water. Yeah, and I've always been like, yo, that's expensive. And then
Okay, so
yesterday
you
he
have
was talking
200 times 0.02.
I haven't actually thought about where I'm going to live, blah, blah, blah. And he was like,
X times
like leasing out an apartment in the woods, blah, blah, blah.
1 plus
That's probably too much.
2 negative
That's probably too expensive. Then he calls his grandma.
0.02, and then we,
How much were they?
it's equal to 2.
Leasing that apartment out for? And she's like, $2,500 a month or something. And he was like, oh. she has her apartment,
She's leasing it out.
which has like multiple rooms, I think, or something. Like it's like not like a studio, but she's leased for.
Oh wait, I think this is actually how we do it. Right, so we have x plus x times.
Yeah, she like literally moved here from Germany and started. I didn't really that conversation kind of ended, but I was like, that's kind of sick.
Okay, then we have 2 minus x divided by 0.02,
Isn't that cool though?
right? Okay, so we have then 2 times, how do we do this? 2 times,
Really? Yeah, I do think she's.
okay, in this case x is,
And I'm like I love that movie so much, but I'm like don't really because we're also seeing D.
Yeah, I'll put it.
2 minus, let's say, negative 0.02.
Because it's an IMAX. That's why I want to. I never saw it in IMAX.
We're seeing the new game, right?
Yes. No, we're seeing the old game.
I need to.
Oh, this actually might be the formula we need. Okay, so x then is, so x is equal to value of portfolio after returns.
Can you finish the book?
Returns.
Maybe if it's deep read it. How long would it take to just deep read it?
Okay,
I have to use my brain for the next couple of weeks.
2 minus x.
I know, but I feel like there might be a considerable
So 2 minus x.
No, I have 15 hours left. Yeah, there's no way I can finish the book right now.
It's November.
I can finish the first half.
So it'll be negative
And that's the first movie.
0.02
Happens also.
x plus x is equal to 2. And we have
Book one.
negative 0.2x,
I wanna say that.
0.02x.
That's actually a good.
Oh, it will be
I
0.08x.
really like the first one.
Wait, 0.98x, sorry. X is equal to 2. So this will be 2 divided by 0.98. So it's,
Yeah, I think he just needs to
okay, 2.04 is the actual exposure that we have after.
That's probably what he wants to do.
Okay.
He like really likes network stuff.
So then we,
I don't know. Seriously.
so value is equal to, value is equal to, buy is buy sell. Okay, so the value that we actually have to buy or sell, we have to get our value back to the x exposure. So I'm hoping, I'm praying that all you have to do is just multiply. I think we just need to multiply. Take the value and let's just see if
What's it called?
we could take exposure
I don't even want to play that loud.
divided by value.
It's something like.
I'm
It's
gonna
like
call
cats screaming, somebody moaning.
Minus 1.
And it's like that for like 5 seconds, 10 seconds, and then it's like.
Oh, wait,
You hang up.
So value minus
I really hope he doesn't answer. Imagine an employer calls him.
exposure minus value divided by value.
Employer. Future employer.
No, like literally, the company.
So that's the
calls
return,
you
right?
the
Buy,
offer,
sell.
And then they hear that and they rescind it.
-2. Okay, I think we're onto something. So we got the -2. So maybe I've been thinking about the calculations a bit wrong. Instead of dividing by the x exposure,
Oh my god.
okay.
Yeah.
It's the same thing, right? Okay.
Kids play. Like, he had to record that on multiple, like,
Yeah.
things playing at the same time.
Do you think he even knows that's his film?
Oh, yeah, no, he, 100%. Maybe voicemail. Do I have a voicemail?
Okay, fund returns is equal to X exposure times returns of market.
Because
Because mine was so annoying, like, you shouldn't play it like that.
okay.
Is that Andrew?
Okay.
Tell him to talk to me for a bit more.
Are you, where are you at? Just hung up.
Andrew. It's okay. When you, are you, where are you? You're in Marvay? Doing work? Okay, so that means I need to do that at some point today, right? I need to do that at some point today, right? Okay, so, question. You wanna do security?
It's exposure.
You wanna do security? Okay. Okay. Have you
Yeah,
read
I'm
the
thinking of,
paper
I'm thinking
from,
maybe that the unbalanced exposure thing might be wrong.
ACK? What's it called? No, what's the thing called? It's like, it's by the dude at UMB, your favorite person. Yeah, that guy. He wrote a paper a couple years ago, called like, it's like basically you send an ACK, like, preemptive.
Okay, so I think, oh man, I think I have to think about how we calculate the value here.
You're 100% because that's like what you're gonna be getting into. You're gonna like do that.
So the value then is equal to,
I'm about to go to the security rating. No. 12:30.
we have our X exposure and we divide that by the returns, 1 minus
Hold up. No, it's not.
by 1 plus returns. So X exposure divided by 1 minus fund returns.
How was the credit networks class?
I think this might be, what if this gives me the same thing? Then I'll be very confused.
Do you think it's doable? Like,
Okay.
divided different masters? Okay, cool. I'll do it on.
So this actually gives me,
Networking class, but like, I'm afraid if I took the regular networking class, I'd kind of feel like a little bit bored. Yeah, I've been doing networking my whole life. No? Think so? Maybe I would learn something. Okay. Cool. Okay. Okay, cool, yeah, because the VGT is very smart,
.003.05.
No, I definitely could. I could, but we just like take, I would probably struggle. I would struggle.
So how am I getting two different things here, right?
Well, it's just like theory. Yeah. I would do that.
It'll be 1 plus fund returns actually. Okay. So that's how I get it for the destabilizing.
Oh, that's awesome. Okay, no worries, I did. Alright, stay on this. Just wanted to talk to you. Talk to you.
Okay, so this is confusing me even more because we do have something that's close, but
From Milan.
Ask her if she's ever been in New York. Say it's like very similar to New York, except people don't speak, like, yeah, it's like basically New York, but, narrower streets.
alright, maybe they have
No,
this
it's
information
really
in this.
Yeah, it has
Like-
the same vibe.
Yeah, like nothing like spectacular.
Yeah, you're not gonna like read being like, wow.
Yeah,
You're just gonna be like, oh, I could've went to New York.
right.
Like, and say that even like the normal.
Okay, yeah, I'm gonna probably read this
Unless you
article
really,
first,
like,
and then think
remember
about
it.
how this could affect the rebalancing. And then I think around maybe 12:30, I'm gonna start working on the other projects.
Oh, yeah. 'Cause then you
Okay.
just bounce.
Right, and then we could, so I was thinking we could go for the
So this-
day to Milan and literally just see like the cathedral and that.
Oh shoot,
And then-
screen froze again.
Walking, no, because when you land in Milan, then you take the bus to the center, or you take a train,
I forgot
and
what
then a
it
bus.
was.
No, you take a bus to the center of Milan, basically the center of Milan, and then,
Okay.
then you take a train.
So the paper studies leveraged and inverse exchange traded funds from a financial stability perspective. Oh shoot.
Don't do that.
That's not bad.
No, the drone is, it's really like not that, like,
Or we could just do a day trip to Milan from
yeah,
Florence
and just like
take the
sleep
train
over
there.
at a hostel. You
Or-
can stay the dude,
or
the hostel I
literally-
stayed in Milan was fucking awesome. And it was 10 minutes walk from the Duomo. It was
Okay.
great.
Or literally
I show that one.
wake up at afternoon and take a
Hmm.
train from Florence to Milan and literally stay there for the day.
Mechanical positive feedback,
It's an hour and a half.
rebalancing of leveraged ETFs.
Yeah.
Resembles portfolio insurance strategies contributed to the stock market crash. I show that 1% increase in a broad stock market index induces to originate rebalancing flows equivalent to
It's 2
1.04
hours
billion. The stock
Or an hour and 45.
price reaction.
But then you waste that.
So we would just sleep there at a hospital, you're saying?
Yeah,
Just take like
it's-
a backpack?
I mean, how, do you really wanna see the Duomo?
Or like,
Like, it's kinda, like,
you think it?
it's not worth it. I'm telling you.
Okay, so it seems like this
Like, if
article
I
is
were
going
you-
to talk about the destabilizing effects of
Like,
leveraged
you're-
ETFs and inverse ETFs. So
Unless, like,
I guess we'll find out what that means. I think destabilizing means as the price of the ETF goes higher, but maybe the price of the underlying stock basket goes higher, then you're going to have to sell off actual shares of that stock to kind of rebalance your portfolio to meet the exact exposure that you
just
need.
think about it, after you fly,
Okay.
10 hours, I don't know how long the flight is, 10 hours, 12 hours?
Damn, what the hell?
GCA.
So I'm reading this article and it has
I,
the professor
Oh, yeah.
Pete Kyle in it. That's cool.
I'm not.
Complex structure and behavior of leveraged and inverse exchange traded funds have raised important questions about the implications. Exchange traded products typically promise multiples of daily index returns, generating multiples of gives rise to.
Oh, you're, okay, so then from Nice you go to Paris.
Yes,
Right.
and then
Paris
from
is
Paris
4
we're gonna
days.
fly, yeah, so then we're flying from Paris to Italy somewhere, but we don't exactly know where.
Commonly used by asset managers in the 1980s.
Let's see, hold on,
Like, Paris is really kind of mid also.
I already bought the things there, so.
Oh, you did? Okay.
But it's like, we leave Paris super early, the last day, so
Okay.
it's,
I mean, you get to, how long is it, like an hour and a half, 2 hours?
I don't know yet, I'm lying. Okay, Madrid, or, oh wait, no,
I think what you could do,
Barcelona for 3 full days, or 4 days.
how long are
Then-
you in Florence
Okay, so it seems like leverage ETFs actually have to rebalance their portfolios
Wait,
daily too,
okay, then we're
in order to meet
Oh, no,
the
we're
actual
in Paris.
kind of leveraged or daily returns
We're in
of
Paris for
some underlying index.
3 days.
And they also have to kind of meet this target stock to cash ratio. Okay.
In Paris, but on the
What?
French. It's gonna be expensive because it'll be like the finals.
I should go.
It's gonna be like $1,000 tickets.
Yeah. It's probably not worth it, but that is a good reason.
I wanna at least walk around where it is and just vibe out in the area.
Yeah, this is kind of confusing because they're talking about how leverage ETFs use swaps and futures contract to rebalance their portfolios. Okay, and the swap counterparties of leverage ETFs are likely to hedge their positions in equity spot or futures market. What the fuck does that even mean? If leverage ETFs use index futures, so index arbitrageurs transfer the price pressure from the futures market to the stock market. Trading.
Yeah, so me.
So does that mean that these leverage ETFs, they'll kind of lock in prices for futures, I guess for maybe 1 day, 2 day prices for
Yeah.
futures contracts on underlying indexes? Okay. Based on total net asset value of 20 billion, when broad stock market indexes change by 1%, leverage ETFs rebalancing demand totals 1 billion worth of stock. So this is roughly 0.84% of daily stock market volume.
I might have to text Ethan. You said Ethan and Devin?
And Devin about Florence,
Should I text Ethan? I think I have his number from that one night, yeah.
Yeah, text.
Calculate the portfolio insurers in 1987 would sell 4 billion.
I was on some shit. Okay.
Weren't you, was it that you were into him or something, or was he?
He left your house and then DM'd me on Instagram.
So leverage ETFs rebalancing in response to large market
I was
move.
like, I don't know. And then it just didn't happen.
Okay, so I'm
Yeah.
thinking that
Nah, I'm just gonna go on.
it seems like a lot of these leverage ETFs actually, the rebalancing effects does have some type of impact on the broad stock market. And
Not just a fucking bullet. I'm sorry.
it has to do with some insurance.
No,
I'm joking.
What?
That was a joke. That was a
I
joke.
know. He gave me the ick though, so I don't think I would.
I know you gave me that.
Because one day I saw him on my phone and he was like,
Okay, rebalancing in the last hour of trading could in fact reduce the possibility of a significant price dislocation, since the market close could serve as a prolonged circuit breaker,
Yes. And I
executing orders within a short period of time,
was not registering. So I was.
such as the last hour of trading may cause disproportionate trades. Okay, rebalancing is an important fraction of daily volume. Alright, so this paper is saying that the way that these leverage ETFs rebalance, they sell when prices are going up and they buy when prices are going. Sorry. They buy when prices are going up and they sell when prices are going down. So it kind of follows the market. I think that's a stabilizing way of rebalancing. Yeah, I think that's a stabilizing way of rebalancing. All right. Follows the different stock market indexes.
Did you go to Rome?
Nope. But generally the recommendation is only go to Rome for 1 day.
Oh my god, I was thinking that. Like, why though? Just because it's so like busy and stuff? Or is it just
Yeah,
'cause, like-
because of that, yes. Sorry, I'm gonna find something for Bumble.
Okay, so I'm just gonna skip to the section straight on rebalancing, see if this has any helpful things that we could use for doing our table. Leverage ETFs typically promise or multiple, okay, producing multiples of daily returns forces. Okay, asset managers generally invest a certain fraction, gamma, of their net assets, WT, into the risky asset online and the rest into bond markets.
Yeah.
Oh, today?
I'm sorry.
Okay, then the investments in the index. Okay, so I think the formula that they use is
Wait, what?
they have the X exposure,
What were you gonna say?
I was gonna say,
they have returns on the markets,
So I'm getting my
Right.
bosses out on the, sorry.
of what? June? May? On her graduation day?
24th, yeah.
Dude, you feel covered in time.
so
My mom's also down to come back.
investment
I would go to 4.
value is equal to X exposure times 1 plus returns.
Aren't you for a month?
You, yeah. Okay,
Okay.
you can't come to, Mies is like, Mies is early. Mies is like June 4th or something. But also like, I'm doing that with my roommates and their friends.
Okay, which day would make sense?
If you came either for the, like, I don't know. So you would want to do Florence. Me and Autumn are doing Florence.
Sure.
Florence. I've always wanted to go. We
Okay,
also-
since
are
the
you gonna go?
leverage ETF is promising gamma over the daily index return on the index.
After June 18th, I don't have anyone to come this week.
Okay, let's see. So
Because I'm
let's
not doing a solo trip.
It's so sick.
let's display. Let's take a look at this investment value. All right.
I already talked to him, and he was like, if like, he said he's down to do this kind of trip, but he was like, I would, honestly. Yeah. I almost did it with him. Yeah, like,
I would be so down. I mean, like, it would have to be something.
Okay.
Yeah, I would go back to Croatia.
I would literally go.
It's promising index. The daily
Oh, yeah.
should be invested on the index to maintain a constant.
I would go to,
I would like to do like the whole. There's so many places to do.
T and the rest. 1 minus gamma.
Rome, and then there's the coast on the bottom.
people always say go to,
WT plus 1.
you know, what's it
In
called?
Italy?
What's it?
Gamma times 1.
Are you talking about the cliff town?
Maybe, that's good. Google Maps.
Is it Cinque Terre?
Since the leverage ETF is promising gamma over the daily return on the index, gamma times WT plus 1 should be invested on the index to maintain a constant.
The problem with Florence is they're doing.
So the rebalancing amount in response to the size of change R in the index can be calculated as.
Yeah, they like starting us.
So the underlying index.
I would not go back to Nice, I guess. Because I'm already gonna be there for like 5 days.
So returns times gamma minus 1.
As long as it's somewhere that's.
Just want to note that when
I would actually go back to Germany. I
Germany
would do the
is
top of
sick.
Germany, because I did the bottom of there. Ooh,
What's that
Netherlands,
on
we
top?
could go Amsterdam.
Bro.
And meet up with.
times gamma minus 1.
Anne Marie.
Oh, bro, well, you know she's in Tyson's corner now. She doesn't live in Amsterdam.
We call her up and be like, this is the time.
Investment
of-
value.
You should come. And then we'll see
You should show us around.
So we have, let's say,
That would be sick. I'd also go to Berlin, Hamburg.
we also have, okay, the returns of markets, and we multiply that by the X exposure, and multiply that by
Yeah, think about it.
X exposure
Yeah, like, I don't have that much money.
minus 1.
And I feel like if you came, you should make like a pretty decent trip out of it, cause it's already good, no expenses. Like, cause most of the money will be flights,
Oh,
like.
okay.
there and back.
I think there's something promising.
So you just haven't planned out, like,
I
okay,
bought my
would say-
ticket there, and I haven't bought it back home, because I want to make sure that I like absolutely am not doing anything else before I buy it back home.
Okay, March, April. So okay, so
I think there's something promising here.
It would be like June 18th.
Is when I would go.
Or like when you would like meet me. Or you could come meet, like be in London for a few days in Florence and do stuff with us.
When would that be?
We're going to Florence on June 12th.
Clutch. That's perfect.
So you could come like,
No, I would fly into Florence.
okay.
Would you get?
You'd want to do the whole trip with us?
For Florence?
For like a week?
I would do Florence.
For like a week?
Hmm.
Yeah.
Okay.
All of Florence? But I'd have to think about it.
Yeah, I know.
And like budget it.
Right.
Yeah. It's also insurance. Could do that.
Yeah, this is kind of weird. Okay.
Because we're gonna book a place soon. And our places that we've thought about only have like 2 guests.
Yeah, wait, why is the 50% one negative, which is, that's kind of weird. 0.3, oh, it's because I have 0.5.
Where am I going?
My friend Erin also went.
Is Florence, if I've always,
0.024.
I would go.
Let's fucking go. Alright,
Yeah.
we got to something. We have values that actually match up with buying or selling. It has to do with this, which I don't fully understand what this means. Okay, let's think about this here. This makes sense, right?
I'm fucking more than that.
So the value at any time of your portfolio is, in this case, sum gamma times WT, and then we add 1 minus gamma times WT. So this is in the bond market, this is in the stock market. Okay, and then we have gamma that we can kind of lever up. So that just means we're increasing our gamma by 2 or 3, maybe even. Okay, so inverse ETFs have a negative gamma. That means you're kind of betting against the actual underlying stock portfolio. Okay, that makes sense, right? Now he talks about the investment on the index. If you assume a 0 interest rate, so the underlying investment then becomes gamma times 1 plus R WT. Okay, so that makes sense because the returns, we can add them to 1 and then we'll multiply that by the actual value of the index itself, and then we kind of scale that by gamma. Okay. Since the leverage ETF is promising gamma over the daily return on the index, gamma times WT plus 1 should be invested on the index to maintain a man, okay. Okay, so I think what this formula is saying then is the actual underlying value of the ETF is going to be 1 plus the scaled return of the underlying index itself. So then we have W. See ya, Elon.
See you, man.
Yeah.
Take care.
You too. So then we have WT times 1, and then we also add WT times gamma times R. Okay. Does that make sense? So WT times gamma plus WT times R. Since the leverage ETF is promising gamma over the daily return on the index, gamma times W plus 1 should be invested on the index to maintain it constant. Okay. So minus T. Times T, so gamma times. Okay. All right. So I'm going to use this for now. So buy sell is equal to, all right. Import pandas as PD. Okay. So exposure to market. To index. So this is return of index, negative 1%. And then we have investment value. So value of index portfolio, and then how much we need to buy/sell to achieve targets. Okay. So with that being said, I think these are all the things we need, and then we can kind of create our data frame. Let's do columns dict. All right. So we can have our x exposure, and this is equal to then the x exposure, and then we have return. This is equal to returns of market, and then we have buy plus or sell minus. Oh, okay. So if it's stabilizing, So it seems like destabilizing is going in the same direction as the market. Alright. Is stabilizing is equal to actually, let's try this. Column stick, and then we could do pd dot data frame. ETF, FDFs, columns, predict. Alright, and then let's display the ETF, FDF. Buy, sell. Oh, shoot. Returns of markets. Oh, wait. Terms of markets. Okay, and then we also have, say, returns. Of portfolio is equal to X exposure times returns of market. There we go. Okay. Nice. All right. Then we could say, column sticked. ETF, DF. So we want to add a column called stabilizing or stabilizing or destabilizing. So this is equal to I wonder if there's a data frame dot map. So data frame map. Okay. I think we could do, yeah. ETF, buy or sell. So we take this column, we can map it, and then we'll create a lambda function. So once we do that, I could say if x is less than 0, it's destabilizing if x is less than 0, else stabilizing, else I could say it is stabilizing. Okay, let's see if this works. Nice. Okay. So this is the final, I guess you could say, outputs of the chart that we need to look at. Okay, so what's the actual question we need to answer here, though? Oh, wait. So if an ETF is leveraged or inverse, then the rebalancing is destabilizing. The amount follows the following. So R times gamma times gamma minus 1 okay, wait. Quarto preview week 6 that QMD.
That's not in mine, is it?
Okay. Oh, is this delta? Let me see. I don't remember all these Greek symbols. Okay, it is. Okay. So, where T is equal to amount is equal to number percent to buy or sell, R is equal return of underlying index, and then delta is equal to the actual, so leverage Yeah, so why is it that if you are shorting, or I guess, yeah, shorting an underlying index, why do you have to sell more than going long that index by however many?
So I have a new solution which I've been thinking about. So my students have been using ChatGPT to generate new OpenMP code.
So why
They
would I
want to
say
OpenMP code. So they're saying they're prompts like we want you to do sorting in parallel.
does one need to sell off stock to balance short position?
So we have a lot of correct output from LLMs, and we could now strip out the OpenMP pragma and give that as an assignment. Well, the problem might be that students could use ChatGPT.
This isn't really that helpful.
So I see, we have 60 different examples. I want to see if there are some examples that are perfect enough. And maybe there are 3 different problems that are more instead of just one. If there are 3 different problems, yeah, like 3 smaller ones. Yeah. Yeah, it's hard. I see, I don't know yet. No, because 11, I have a class at 11. Yeah, I cannot even have the talks because of the. Yeah, I'm meeting with them in the afternoon. Hey, I'll see you in the afternoon.
Yeah, me too. I'm coming in late.
Kintusen. So if you are buying shares in a leveraged long ETF, this is most similar to. Okay. So why is the different? It's twice the amount usually. Point 5. This is kind of confusing because there's a pattern here where if you're shorting the index and you're exposed by, let's say, a certain amount, then as you can see, there's like a one difference in the sense that this is -1, this is 2. Okay, so maybe there is some kind of economic, maybe theory behind this. Really, when you're going long 200% in index, you have 100% and then an extra 100%. So you already have this kind of 100% of your index built in to your 200% exposure. If you're going short 100%, then that just means that you're kind of, how do you say this? You can maybe say it's the exact opposite of going long 200%, but you're taking the inverse of that maybe. And so then you have the exact same buying and selling patterns whenever yeah, okay, maybe then you have the same buying and selling pattern. So the rebalancing effect is different for levered ETFs and ETFs because of the Because if it's different from 3x lever long ETFs and okay, so I think the actual reason why the rebalancing effect is different is because when you have a short position, you're actually more exposed to you have a more destabilizing exposure than the levered ETF, than the 3x levered ETF. There is more of a destabilizing effect on the short position. I'm not too sure exactly how to word this, but there's already 100% exposure built into the 3x. Then the long position. Okay, I'll just end it at that. Okay. So if you buy shares in a levered long ETF, is this most similar to buying a call option? I think so. So levered long ETF is like buying a call option. What does writing a call option mean? What does the payoff diagram look like? So, okay. Wow, the short ETF is like buying a put option. Okay. I think the levered long ETF. Okay. Okay, so I kind of understand now. If you're the writer of a call or a put, I think the maximum profit you can actually have is the premium generated on the options contract. Unlike if you're buying a call or buying a put. If you buy a call, I think your profit is essentially unlimited. If you're buying a put, I think your profit is limited by the current price of the stock and the amount of leverage that is incorporated into the options contract. Okay. So I think in that way, the lever long ETF is like buying a call option where your profit is essentially unlimited, and then you're also leveraging up on the ETF, I guess on the underlying stocks in the ETF. Short ETF is like buying a put option because you're kind of shorting say, basket of stocks, kind of like a put option where you're buying the right to purchase the stocks at a oh, sorry, you're buying the right to sell a stock at a certain price. Okay. So what are the commentators trying to achieve politically? Yeah, I think these are going to be the extra credit questions. So what are the commentators trying to achieve politically? Okay, read some of the comments on the OFR report submitted to the SEC. Okay. Oops. Okay, so right now I'm going to try to answer these questions of what the commentators are trying to achieve politically, and do they generally agree or disagree with BlackRock. So I think the question to ask here is, what is BlackRock disagreeing with the Office of Financial Research? I think the general idea is that asset managers pose a systemic risk to kind of the overall broad capital markets industry. And so I guess maybe that's something that I should probably think about when I'm reading through these articles to see whether or not these people agree. Now, this question is asking what the commenters are trying to achieve politically. I'm not exactly sure on how you could have kind of this liberal conservative view on the asset management industry. I would guess that maybe if you fall into a more Democrat or liberal left point of view, you'd assume that these asset managers are kind of a big systemic risk to the entire capital markets. While if you're more conservative or right-leaning, you might agree that with BlackRock that the asset managers are not really a systemic risk. So that's just kind of face value of what I think. I could be wrong. So I'll see what these guys have to say. First one, girl named Elizabeth Murphy. She is... Okay, never mind. That's who it's to. The guy is David Hirschman. I think he's maybe the president of the Chamber of Commerce, which I don't know what that is exactly, so that's not good. World's largest business federation. Okay. Okay, so it seems like the Chamber of Commerce guy. Commerce. Agrees with BlackRock. Okay, so I think maybe politically they are trying to prevent regulation. I think I might have misquoted or misspoke on this. Maybe it's not really what different political sides are trying to do, but more so how regulation might impact this industry. So I think politically, they're trying to deregulate the asset management industry from I think the Federal Reserve is a big regulator, and then also Congress, maybe they enforce some rules. All right. Believes that managers act as agents. Okay, so there's that. What? Okay, so what I've noticed is that some of these people that are commenting on their research report are also asset managers. And so I feel like if BlackRock is disagreeing because they want to be deregulated, other asset managers, one of them is Vanguard, would also probably agree with BlackRock. I would think that their objectives are similar, and they definitely do not want to have possible increased scrutiny by the Federal Reserve and by Congress. Vanguard agrees with BlackRock. So the commenters that represents asset management firms. Capital Markets Committee. What does the Chamber of Commerce do? So most of the comments are from industry, are from asset managers similar to BlackRock or government/institutions that represents the interests of asset managers. These comments are trying to usually disagree with the SEC about the systemic risk associated with So these comments usually disagree with the SEC about the systemic risk associated with asset managers. Want to reduce regulation in the industry. Harmful regulation in the industry. So they also don't. I also think that these guys are trying to kind of paint a nice picture of what the asset management industry does, and in effect show the public that so maybe I could say there's kind of this marketing aspect to this where these asset managers don't want to be seen as bad people. There is a marketing aspect to their comments to show that asset managers aren't bad people or take on Generally, these commenters do agree with BlackRock, but should be noted that most of them share similar interests to BlackRock. Okay, so to leave it at that. What I'm gonna do now is probably, I have maybe a few more questions left. I do have to use the bathroom, so I'm gonna go do that, and then when I come back, I think I might start on my other projects for the portfolio management class. Yeah, I think I'll do that. I was kind of putting that off for a while now. That one's a bit hard, so I need to start ASAP. Alright, well, I feel like we got a little bit of stuff done today, which is nice, and I'll see you guys in the next stream.